When it comes to investing, there are so many different ways to go about it. Many different philosophies and strategies, each having its own proponents and critics. So today, we're going to look into one of those famous Wall Street debates, active versus passive. What do those mean, and which one is better for you? We'll tell you everything you need to know. Active and passive investing are two strategies that are typically used in funds, which are baskets of securities. The most common types of funds are mutual funds and exchange-traded funds, also known as ETFs. In actively managed funds, the fund manager selects which stocks or bonds will be part of the fund. They do that to beat the market, which basically means to get a better performance than certain stock and bond benchmarks. In active investing, there's a lot of selling and buying of stocks trying to beat the market. So for example, in 2022, which was a terrible year for markets, the S&P 500 lost a little over 18%, including dividends. So an active fund trying to beat the market would have to do better than that, so perhaps lose less than 18% or even gain a little bit. That might sound easy, right? But now let's take a look at the previous year, 2021, which was a killer year for the market. The S&P 500 gained a little over 28%, including dividends. Beating that is so much harder. Passive investing, the funds simply mirror what's happening in a given index, so the manager doesn't select which stocks or bonds will go in the fund. The goal is not to beat the market, but to deliver the same returns as the market, or more specifically, the index that the fund is tracking, like the S&P 500 or the Dow Jones Industrial Average. So taking those same years again that we talked about earlier, 2021 and 2022, a passive fund tracking the S&P 500 would gain about 28% in 2021 and lose about 18% in 2022. The oldest passive fund in existence tracks the S&P 500 and was started by John Bogle, founder of the investment giant Vanguard, in 1976. Today, there are several passive funds tracking the S&P 500, and they're all basically doing the same thing, trying to match the performance of the index. However, they offer different features, such as different fees or investment minimums. Also, some will invest in a small portion of the index, while others may track the entire index. So those could be some reasons to pick one versus the other, even though they all try to deliver the same result. Passive funds have become massively popular, and in 2019, for the first time ever, the amount of money in passive mutual funds and ETFs surpassed the amount in their active counterparts. What makes passive so popular? One big reason: low costs. Since passive managers only need to mirror an index, they don't have to spend money on research and other costs related to selecting investments, buying and selling. Passive funds pass on those savings to shareholders in the form of lower fees. How much lower? Morningstar said in its most recent annual report that passive funds charge an average of 0.12% versus 0.59% for active funds. That's 5 times lower. That's important because fees are taken out of your account. So if you have $10,000 in your portfolio, a passive fund would take $12 out of it, versus an active fund would take $59. Now, that might seem small, but what if your money grows to $100,000? In that case, the difference in fees is between $120 versus $590. So bottom line, lower fees can leave more money in investors' account where it can be invested for future growth. And when those savings compound, a little can go a long way. So it's clear that active funds are more expensive, but does more expensive also mean better? That's where the real debate starts. And the answer depends on the time period you're looking at. We've recently been in a time period that some people call an active renaissance, because over the 12 months through June 2023, actively managed funds outperformed passive funds. That was their highest success rate in years. That also coincided with a time when the market rebounded in 2023 after a terrible 2022, so people that invested in active funds got the most bang for their buck. But this wasn't always the case. In fact, for many years, passive funds outperformed their active counterparts, and that was especially true in 2022. Amid the stock market rout, passive funds outperformed active funds. So in that case, investors that paid more to get an active fund ended up getting a worse return on investment. So what should you do? There's no way to predict future market returns, and therefore no way to know if passive or active will perform better in the future. If low fees is what you're looking for, then passive funds could be a good choice for you. And if you're one of those people that think expensive must be better, think twice, because research company Morningstar found that the cheapest funds succeeded more than twice as often as the priciest ones over the 10-year period through 2022. On the other hand, active funds can offer strategies that don't match up with existing indexes. For example, some active strategies may focus on reducing risk, hedging, or even specific trends like AI or blockchain. Whether you opt for active, passive, or a combination, remember to base your investments on your goals, time horizon, and tolerance for risk. And if you're overwhelmed, you can always consult a trusted financial advisor who can point you in the right direction. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for more videos, and we'll see you next time.